I'm excited today because I'm doing a bite-sized show on something that will make a big difference. It's going to change your business and change your life. Are you willing to embrace this and give it a shot? Because it could really make a huge difference. More on the exact topic in a second. I just want to say that I hope you listened last week. We had a great guest on named Will. We talked about the power of focus as you're growing your business. We talked a little bit about tech side, AI, automation, really valuable and practical information. And we're going to get a part two to that discussion that I'm excited to share. So stay on the lookout for that. But for today, it's just a bite-sized episode on a tool that will really change things for you if you will take your time to embrace it. What I spend most of my time on these days is fractional CFO services. That's a service for a higher level operator, somebody who's in growth mode, possible multiple locations, expanding growth, someone looking for forward-looking thinking. Yes, there's analysis of data. There's looking underneath and finding out the story that the numbers are telling, but it's more forward-thinking than anything. And I'm going to possibly do another episode all about what that looks like, just so you're aware if and when that might be an option for you, or even for now, if you're not there, maybe it's there are things you can do, because at some level we have to be the fractional CFO of our own business if we're not at the point where it does make sense. More on that in the future, but for today, I want to share one of the components that I think is really valuable for my CFO clients that can be valuable for you. And I want to share that with you today, so you can start implementing and you can start creating a better handle, more clarity, a better decision making. And what I'm talking about today, the tool that I'm referring to, is the 13-week cash flow forecast. We're going to talk about why I'm talking about that. We're going to talk about what it is and how to do it. And again, all in a bite-sized episode. Maybe you're not super into the numbers, and if that's the case, don't tune out, because it's such an important component of your business. Don't make the mistake like so many make and say, oh, it's not important. I just need to make more sales. Yes, more sales does solve a lot of things, but most of you're making enough money at least to potentially do better than you are, to have more clarity than you are, better decision making, better likelihood of reaching your goals. We can go on and on about it, and I talk about it a lot, but more money, that's both personal and business. It doesn't solve everything. So we're going to talk about this idea that most gym owners, and you can think through your situation, most studio owners, gym owners, anybody in that sort of space, you may have a lot of spreadsheets. You might have, I've seen 16 or more spreadsheets and all the KPIs, and we're tracking all of the things in there. We're tracking our set, show, close. We're tracking our sales. We're tracking our recurring revenue. There's all of these things, and sometimes there's multiple sheets for these things. And at the end of the day, while I'm all for the KPIs, we want to make sure that we're using the information that we have, because it's not just about having the information, it's about understanding the story that it's telling us and what to do next. And that's what we want to determine with the data that we're analyzing, that we're using, and that we're reviewing. So the too many spreadsheets is the reason why I'm sharing this, because what we want to do is we want to distill it down to what matters most. I like to say, when it comes to reporting, KPIs, and that sort of thing, I like to say that you want to have the least amount of data that tells you all you need to know, because more things and more data is not always the answer. And I'm going to say that most studio owners and gym owners are not necessarily focused on the right information, on the right data. We want to make sure that what we are looking at gives us the ability to make decisions. And while looking in the, what I say in the rear view mirror, like looking what happened last month, last quarter, last year, that will be looking at your financials. By the way, it's kind of a misconception that what we do here at Fit Profit Solutions is just bookkeeping. That's so far from the truth. The bookkeeping is really, really important, and it is absolutely a non-negotiable. So if you don't have your books up to speed, that's like square one. Because if you're not looking at what I call the central source of truth in terms of your numbers, it's going to make the other parts really difficult. But it definitely doesn't stop there. I would say that's probably like 10% of what we do. Most of it is more forward thinking. I was like, what are we doing next to gain more clarity, to have more peace of mind, to feel safer, to make sure we're moving the ball down the field. And the whole fractional CFO thing is, I don't know, it's gotten a little bit more buzz lately, and I see all these people popping up saying they're a fractional CFO, but when you really look deeper, they're not. They're more of just like a bookkeeper. They're just providing reports. Maybe that's glorified bookkeeping with some extra reports. That's not what we do. What we do is we really look forward. We say, okay, where are we now? Where are we going? How are we going to get there? How can we avoid the dumb mistakes that can be really costly when you're at a certain level? And how can we have clarity with where things are and where we are going? And that's where we're going to introduce the 13-week cash flow forecast. And there's lots of different reports. And as I mentioned, we want to have the right data when it comes to our financials. I'll just run through them quickly. There's the profit and loss, which shows your the amount of money that's coming in through sales, your total revenue. There might be some cost of goods, which then will get you to your gross profit. Most of you listening, that's not a huge thing because there's not a ton of cost of goods generally. And then there's going to be all your expenses, your fixed expenses, your variable expenses. So the fixed are the ones that are the same every month. The variable are the ones that change based usually on business volume or other things. You could just make obviously random decisions and have more expenses if you want to invest in something. And then what's left is your bottom line. So that's the job of the profit and loss or the income statement. There's your balance sheet, which shows the assets that the business has, like kind of like what it owns. There's the liabilities. That is what it owes, the debt and those kinds of things. And then there's the equity side, which is basically what you own within the business, right? So it's not what the assets are what the business owns, and the equity is sort of like the shareholder, which is you, what you own in the business. And those things are all really important, and they're different. They flow together. There's another statement that's talked about a lot less, probably a lot less than it should, and that's your statement of cash flows. Really interesting and really helpful. I'm not going to get too in the weeds of that, but it essentially does track your cash flow, like starting cash and then ending cash and like what caused that. So maybe we'll do more content on that, and that's important. But the cash flow forecast will 100% use data from either all or most of those other reports that I mentioned. But what it is it tells you what's arguably the most important thing in your business. There's a few things that are really important, but the amount of cash that you have is absolutely crucial. And most business owners, operators, gym owners, studio owners, they can look at their cash balance in their bank account and they make decisions based on that, right? Okay, so I have, I don't know, $50,000 in the bank. So this thing that I want to purchase is $3,000. Okay, I have enough, right? Because I have 50, so I can buy something for $3,000. Or I only have 10,000, and maybe I shouldn't buy this thing for 3,000. That's how most people operate, and many people are following something like Profit First, which has a lot of strengths. With that said, it's more we call bank balance accounting, where we're making decisions based on what our account says, rather than forward thinking, which is really what I'm trying to drive home today, of where are we going to be based on those decisions. That's why it's called a forecast, because we're projecting out and we're saying, okay, based on X, Y, and Z scenarios, this is where we're going to end up. But where the cash flow forecast comes into play is it's only, and this is the key distinction between some of the other things, it's only cash movement. So on one hand, it's really simple, But on the other hand, it can feel complex because we don't all have an understanding of what cash movement is. We think, okay, I pay $500 a month for my Meta ads or something, and that's a $500 cash outflow. And now it may be, but it may not be. So I want you to think through: does money hit my bank, or does it leave my bank? And if that's the case, then it should be included on your 13-week cash flow forecast during the week that the money came in or the money left. We're talking about cash basis, not, for example, Mrs. Jones said she's going to purchase, $8,000 worth of training. So that doesn't count until that $8,000 actually hits your account. Even if there's a lag in terms of when you actually get paid, it would count when you collect that money. What are some ways that cash comes in? Obviously, it's sales, right? You make a $1,000 personal training sale, $1,000 hits your bank, it counts as inflow. Or maybe there's fees taken out before the money hits, right? So if that's the case, then you either have to include the fees on your outflow, or you just exclude them from the start, right? So if you make a $1,000 sale, but you only get $950, $950 would go on that forecast. As far as money coming in as inflow, that's the main thing is sales. There are other ways that money could hit on the inflow side. There could be a refund. You might do what's called an owner contribution, which means you're putting money, you're infusing the money into the business. There could be a loan and money coming into the business through borrowed capital or debt. That even though it's debt, and as you know, I want you to be super careful of debt. That potentially could add cash coming in. It's ultimately going to lead to cash coming out too. But for the sake of this conversation, we're talking about the inflow, and then the outflows. I think is where it can be a little more confusing for studio owners and operators and gym owners, and that is it's your expenses where the cash actually leaves. Here's a perfect example. If you pay $500 for Meta ads, use the same example, and that charge is being applied to a credit card, that cash doesn't actually leave your operating account until that amount gets paid, right? So you're only going to include actual cash movement on your forecast. So if you put $500 on your card and it gets paid in 2 weeks, then that point when it gets paid is when you count that cash leaving your business. What else? Loan payments. If you have a $1,000 loan payment on the 15th of the month, that is $1,000 leaving your operating account. So therefore, you're going to have to include that on your forecast. If there's a distribution, so maybe you pay for something personally, which you know you shouldn't, but you did it anyway, that came out of your business. That's not going to show up on your P&L, but it needs to show up on your cash flow forecast because it's money that left your business. Or maybe it's just a distribution. Maybe you're an LLC filing taxes as a Schedule C, and you are taking what's called a owner distribution. And in that case, that would have to show up on your cash flow forecast. Might not be on your P&L. And those would be some of the things that would show up there. And we can keep it really simple because I want to give you some marching orders to take action on this stuff. It reminds me of a guy that I've been working with. When he started, he reached out and he was sharing how he had just had his best month ever. So he looked at his sales, he looked at Stripe, or he looked at his QuickBooks Online, and he had the most sales he ever had. And that very same week, he couldn't make payroll. So here he is. He had his biggest sales month in history, but he couldn't make payroll. He had to infuse personal cash into the business to make payroll. And that's when he reached out to me because he's like, listen, and it's so wise of him, because he realized, he said, sales was not the answer. This all came down to managing my cash flow. So sales is one thing, and it's not unimportant, but managing your cash flow is another, and they are different things. He had the sales. That didn't solve the problem. He still ran out of cash. And his results have been phenomenal. He applied a lot of what I'm talking about here. We worked through it together. We created the cash flow forecast. He's doing it on his own. I'm going to share what you can do for that to keep it really simple. So hopefully that makes sense as far as what's on it, what's not on it. So that's the litmus test. Does this cash leave your bank? Does it come into your bank? If so, it's on your forecast. And I want you to do this on a weekly basis you can start with 2 weeks, right? But ultimately the 13 week gives you some good visibility. Now we know it is just May 15th, for example. And now by doing the 13 week, we can push out, and maybe that brings us to, I don't know, the later part of August or something. We know based on these inflows and outflows, we know where we're going to be from a cash perspective. Number one rule in business, don't run out of cash. We want to make sure we're putting that cash to the best use based on your goals. Maybe you're paying yourself more so that you can build some personal wealth and freedom. Maybe you're looking to stack your cash so that you can reinvest in the business. You can grow your business. You can make a hire. You can open up another location, and you could do that with either no debt or less debt. Those are all really worthy causes. But without doing the forecast, you're not going to be able to do that, because then you're just kind of just guessing, and you're either not going to make it, or it's going to be much slower than if you were to do this. I promise you that. So that's what goes on it. And how to do it, I want to give you a really simplified version and start there. You can do this on your own. I mean, you could almost do this just on a yellow pad or a basic spreadsheet, but I also do have a really cool form. It's just a Google sheet. If you want to reach out to me, I'll send that over to you. No charge. It's billy@fitprofitsolutions.com, billy@fitprofitsolutions.com, and just say you want the 13-week cash flow forecast basic form. Because like anything else, there's ways to add some nuance and add some detail to that. But in this case, all I want you to do is get to the habit of forecasting. And what you're going to do is let's just pretend that, let's see, May 2nd, let's say May 4th is a Monday. You're going to say, okay, starting cash on May 4th, and that's going to go on your forecast, right? And then the end of that week, let's say it's a full calendar week, let's say it's May 11th, what's your ending cash going to be? So what cash is coming in from May 4th to May 11th? How do you determine that? Well, you can look at a few things. You can look at your last few months to get an idea. You can look at, if you're using Stripe or something similar, you can look at there. You can get a report on what you've been doing and what the trend lines are, right? For the last few months, you've been doing about this amount on that first week of the month. Maybe you're a little up, a little down. You base it on what's happened in your business. You got some new clients. You lost some clients. You could also look at previous year and what you're up year over year or down year over year. So it's a mixture of that data as well as just your common sense, because you know your business. And the more you do this, the more accurate you'll become. And from there, you have the inflows, again, the sales that came in. You have the outflows, which could be, again, those distributions. It could be your expenses. It could be debt payments. And then you're going to have a number at the end, right? And the goal is, depending on what the starting cash is, you want to look at those patterns. And what I want to encourage you is, if you see, let's say, something you don't like, that doesn't mean it's time to panic or make any major, and it might be the case to do that, but oftentimes it's not, right? You want to look at the full picture, you want to look at the patterns, and from there, we can adjust timing. We can improve the cash coming in and the timing of it, or we can adjust the cash going out and the timing of it. But I encourage you, don't just do this and say, oh my gosh, I have to cut everything, and then you start cutting things that are actually really helpful, especially in the long term. But the key is actually just getting that visibility. And now, who should do this? I would argue anybody, especially this version of it. It's really basic. It's just doing starting cash coming in, cash going out, and then you have your total. But again, it's during that particular week. If your rent is due on the 1st, it obviously doesn't go in your forecast on the 15th or later, right? It goes during that week. I would say if cash flow is a little bit tight, it is a perfect time to do it. Even if cash flow is really good, I'd still encourage you to do this basic version, because I know from my own experience, as well as the hundreds of owners that I've worked with, that when things are going well, that's the opportunity for you to make some mistakes, because you get a little comfortable, right? So this helps keep you honest. And again, you can make mistakes either way, right? By underspending, overspending. You want to make sure you're doing, you're just getting that visibility. You're making the decisions that make sense for your business. I find that people fall into like one or two or three camps. So on one hand, they don't know what's going on, so they don't spend anything, and that limits their growth. Or maybe they don't see they don't have the visibility, so obviously they overspend. That's definitely a problem for some people, and it just doesn't make sense based on where they're at. So you want to kind of find that sweet spot for you, but you need to get that visibility before you can make those decisions. We generally just make these random decisions based on how we feel, right? A client cancels, so then we make a decision. We get a new client and we make a decision, but we want to be a higher level operator. That's my goal for you, so you can really make a difference here in your life, in your business, in the people that you employ. You can really be a good steward and a healthy operator. A couple common mistakes before we wrap up here. Number one is perfection. You're not going to be perfect. It's always a moving target. You don't know. I've been doing this for many years. I still don't know the exact revenue I'm going to have this week, right? Because I might make a sale or lose a sale that I expected or didn't expect, right? So you're not looking for perfection. It's just you're just doing your best, and your best is good enough. You also want to be careful not to be too detailed, especially with this version that I'm talking about. You want to just look at the overall, right? The big picture. Okay, this is where we're starting. This is where we're going to end at the week. It doesn't have to be correct to the dollar. You may want to do some like forecast versus actuals, right? Like you could have maybe two columns, or one thing I've seen people do, and I've done with a few people, is in the inflow part, you put the amount, and then you have another field where you're putting what actually comes in, and then it kind of deducts from what you said. So let's say simple numbers, like I expected $5,000 to come in this week, and then you started at $5,000 and you make $2,000 on Monday, and then it reduces the 5,000 to 3,000, right? It just kind of pulls down to see how close you are to what you thought. That's always cool too. You're gamifying a little bit. You definitely want to do this at least weekly, if not more often, depending on how tight things are. If things are super tight, you might want to look at this daily, not in an obsessive way, but just in a way that helps give you as much clarity as possible. And I think the last mistake you can make is thinking that this stuff is only for like the sophisticated operators. Like I don't know. I just think all that stuff is nonsense. I hear a lot of stuff out there, and people are just using like this corporate language, and there's no need for any of that. Whether you are making $20,000 a month, you're making $100,000 a month, you're in the multi-millions, either way, it's the same for everybody in that sense, in that there's no point where this starts making sense to do. There might make it might make sense to bring somebody on like me or my firm, because now the stakes are higher and you really want that leadership from the outside. You don't want to pay huge bucks, a couple $100,000 to bring in somebody as a full timer on this, but you're looking for somebody in a fractional role. Of course, right? It's like that would be true in any important area. But it's not because you're newer and this doesn't apply to you. This is something that makes sense to build a foundation, and it makes sense at the highest level. If you have no issues with cash flow at all, you're flush with cash, it's not a stress, not a concern, maybe it looks a little bit different. I still think there'd be value in doing it, because you see people make mistakes when things are really tight because emotions get the best of them, and they also make mistakes when things are really fat. I remember before COVID, at one point we were doing really well. We're kind of at our peak, and I had some hires that I shouldn't have had, and other big financial decisions because things were so fat that I just kind of ignored them, didn't notice them. And this kind of thing would have helped for sure, and it'll help you just the same. So I hope this is helpful. If you want help with that sheet, just reach out, billy@fitprofitsolutions.com. I plan on my goal is to bring you valuable content, because I want you to not just get by, but I want you to really live your dreams, make the biggest impact you can, to grow your profits, to grow yourself, and to just keep growing, keep thinking bigger, and and ultimately gaining the freedom that you'd like, so that you can grow into all you are created to be. If this was helpful, let me know. If any of it was confusing, let me know. Trying to keep it concise so that you don't fall asleep, but also I want to give you enough information that you actually know what you're doing. So again, this is really just to help you. So let me know. I would love your feedback. It matters. It helps. You can shoot me a message on Instagram or LinkedIn, or you can hit me up on the email I mentioned, and I'll put it in the show notes as well. Thanks so much for listening, and yeah, stay plugged in. This is the stuff. This is the stuff that you need. I'm biased, but it is. Until next time, you're listening to the Your Fitness Money Coach podcast.